Ladies and gentlemen, today I want to start with a sentence that should stop you in your tracks. The silver market is sold out, and yet there are no bids. Think about how strange that sounds. A market where supply has vanished, prices have smashed all-time highs, and still the world is pretending nothing unusual is happening. History tells us that moments like this don't announce themselves with fireworks. They whisper first. And right now, silver is whispering something very important to anyone who is willing to listen. So what does this mean for you? It means you must stop thinking like a spectator and start thinking like a decision maker. Markets don't reward attention, they reward preparation. You don't need to predict the exact top or bottom. You need to recognize when probabilities shift in your favor. Silver, breaking ATH while physical supply tightens, is one of those moments where probabilities speak louder than opinions. When we talk about a physical supply shock in silver, we are really talking about the moment when theory collides with reality. On paper, silver appears abundant, liquid, and endlessly tradable. Contracts change hands thousands of times a second. Prices flicker across screens, and the market gives the illusion of depth and stability. But beneath that digital activity lies a much harsher truth. Physical silver is not moving with the same ease. Vault inventories are tightening, delivery timelines are stretching, and premiums on real metal are quietly rising. This gap between what can be traded on paper and what can be delivered in reality is not a small technical issue. It is the kind of stress fracture that, once visible, cannot be ignored. The modern silver market has been built around leverage and promises rather than ounces. A single bar of silver can be claimed by multiple contracts, each one assuming that delivery will never actually be demanded at scale. For years, this structure worked because confidence remained intact. Most participants were content to settle in cash, roll contracts forward, and treat silver as a price exposure rather than a tangible asset. But confidence is not permanent. When industrial users, sovereign buyers, or long-term investors begin to insist on physical delivery, the math changes instantly. A market designed for trading suddenly faces the limits of its own inventory. This is where the phrase "sold out but no bid" becomes so powerful. It signals a market in which sellers are no longer eager to provide supply at current prices, not because demand has disappeared, but because expectations have shifted. Holders of physical silver are recognizing that their asset is not easily replaceable. They understand that once an ounce leaves their control, reacquiring it may be far more expensive or even impossible in the way. Short term, that realization turns passive holders into strategic ones, and strategic holders do not rush to sell. What makes this moment especially compelling is that it is happening quietly. There is no dramatic collapse, no flashing red warning signs for the average observer. Instead, there is a subtle withdrawal of liquidity, fewer offers, longer waits, and a growing reluctance to part with real metal. These are the early signals of a market under strain. Historically, when physical supply tightens while paper activity remains elevated, price eventually moves to reconcile the contradiction. This is not a story about fear or panic. It is a story about incentives. Markets function on willingness to sell, willingness to deliver, willingness to trust the system. When that willingness starts to fade, even slightly, it creates conditions for abrupt repricing. The silver market today is standing at that edge, where perception still lags reality, and where those paying attention can sense that the balance is shifting faster than headlines suggest. But when silver breaks through an all-time high, it is tempting to dismiss the move as emotional, speculative, or driven by short-term momentum. That instinct is understandable, but it is often wrong. All-time highs are not random events. They are moments when accumulated pressure finally overcomes resistance that has held for years, sometimes decades. In economic terms, this kind of breakout is not a burst of excitement, but the visible release of long-building structural forces. Price does not reach uncharted territory unless the underlying balance between supply and demand has already shifted. Speculative rallies tend to be loud and fast. They are fueled by leverage, headlines, and crowd psychology, and they often collapse as quickly as they rise. What we are witnessing in silver is fundamentally different. The move higher has been supported by persistent demand, tightening availability, and a growing recognition of silver's strategic importance. Each pullback has been met with buyers willing to step in, not because of hype, but because the metal is increasingly difficult to replace. That behavior reflects conviction, not excitement. And conviction is what sustains long-term trends. An all-time high also carries psychological weight that markets cannot escape. Previous price ceilings act as anchors in the minds of investors and institutions alike. Once those anchors are removed, the market is forced to reevaluate value from a new baseline. There are no historical reference points to justify why price should stop at a particular level. Instead, valuation begins to revolve around forward-looking factors: future supply constraints, projected industrial demand, and macroeconomic risk. This shift in thinking is subtle but powerful because it changes how capital is allocated. Another critical signal lies in the behavior of participants during the breakout. In speculative moves, volume spikes dramatically and then fades as early buyers rush to take profits. In structurally driven moves, participation broadens. Long-term investors, industrial users, and institutional allocators begin to increase exposure, not all at once, but steadily. They are not chasing price, they are adjusting to a new reality. The result is a market that climbs not in a straight line, but with resilience, absorbing selling pressure rather than collapsing under it. There is also a timing element that makes this breakout especially meaningful. Silver is moving higher in an environment already defined by inflation, uncertainty, elevated debt levels, and fragile confidence in financial systems. In such conditions, markets are less forgiving of mispricing. Assets that have been undervalued for extended periods tend to adjust more decisively once recognition begins. Silver's move above previous highs is less about enthusiasm and more about correction. The real hook in this moment is that structural breakouts rarely announce their full potential at the start. They look ordinary, even suspicious, precisely because the narrative has not yet caught up with the numbers. For much of modern financial history, silver has been viewed primarily through the narrow lens of a precious metal, valued for its monetary heritage, but overshadowed by gold in strategic importance. That perception is now outdated. The global economy is undergoing a technological and energy transformation that has quietly elevated silver into a position of critical relevance, unlike many raw materials that can be substituted or scaled easily. Silver possesses unique conductive, thermal, and reflective properties that make it essential in applications where efficiency and reliability are non-negotiable. This shift is not theoretical. It is already embedded in production lines, infrastructure plans, and long-term industrial investment decisions. Every solar panel installed, every electric vehicle produced, and every advanced circuit manufactured increases structural demand for silver. Renewable energy systems, in particular, are silver-intensive by design. Governments and corporations may debate timelines and targets, but the underlying material requirements are fixed by physics, not policy. As electrification expands across transportation, energy storage, and data infrastructure, silver consumption becomes less discretionary and more compulsory. This changes the economics of the metal. Demand is no longer driven primarily by price sensitivity or investor sentiment. It is driven by necessity. What makes this transformation especially powerful is that industrial demand does not respond quickly to price signals. Manufacturers cannot simply stop using silver when prices rise, nor can they easily redesign products to eliminate it. Without sacrificing performance, this creates a form of inelastic demand that strengthens the market during periods of tight supply. Even modest disruptions can have outsized effects when end users must compete with investors for the same limited pool of metal. That competition is already emerging, and it is reshaping how silver is valued. There is also a strategic dimension that markets are only beginning to appreciate as supply chains become more fragile and geopolitical considerations influence trade flows. Access to critical materials takes on national importance. Silver sits at the intersection of energy security, technological advancement, and defense capability. This elevates it beyond the category of a simple commodity and places it closer to the realm of strategic resources. When that reclassification occurs, market behavior changes. Stockpiling replaces just-in-time sourcing, and long-term contracts replace spot market dependence. The hook in this moment is that silver's industrial role is expanding at the same time its availability is becoming more constrained. That combination is rare and historically potent. Markets can adapt to rising demand if supply is flexible, and they can absorb limited supply if demand is weak. They struggle when both forces move in opposite directions simultaneously. Silver is now firmly in that zone where its importance to the future economy is increasing faster than the ability to produce it. Once a material reaches that point, price is no longer just a reflection of value. It becomes a mechanism for rationing scarcity in a world that suddenly needs more than it can easily obtain. But one of the most telling signals in any market is not what buyers are doing, but what sellers are choosing not to do. In the silver market, the emergence of no-bid conditions reveals a quiet but powerful shift in behavior. This is not the absence of interest, it is the deliberate withdrawal of supply. When major holders step back from offering metal, they are making a statement about expectations. They are signaling that current prices no longer compensate them for the risk of being without an asset they believe will be more valuable in the future. The hook in this moment is subtle but powerful. Markets do not break when everyone is selling, they break when no one wants to. When supply is withheld by choice rather than force, price must adjust to entice participation back into the system. In the silver market, that adjustment process appears to be underway, driven by institutions that are positioning not for the next trade, but for the next phase of the economic cycle. The sensitivity of silver prices to even small shifts in demand is not accidental. It is the direct consequence of a supply side that has become increasingly rigid. Mining output, once assumed to be responsive to higher prices, is now constrained by factors that cannot be solved with capital alone. New silver discoveries have become rare, ore grades have declined, and environmental and regulatory hurdles have lengthened the timeline from exploration to production. In economic terms, this means the supply curve has flattened, reducing the market's ability to absorb shocks without significant price movement. Silver's production profile adds another layer of complexity. A large portion of global silver supply is produced as a byproduct of mining for other metals, such as copper, lead, and zinc. This means silver output is often dictated by the economics of entirely different markets. Even when silver prices rise, miners cannot simply increase production unless it also makes sense for the primary metal being extracted. This structural dependency limits flexibility and weakens the traditional assumption that higher prices will automatically bring more supply online. Costs are also rising in ways that directly affect pricing dynamics. Energy, labor, equipment, and compliance expenses have all increased, pushing the break-even point higher for many producers. When costs rise faster than prices, investment slows, projects are delayed, marginal operations are shut down, and expansion plans are reconsidered. The result is a market that becomes tighter not through sudden disruption, but through gradual underinvestment. By the time the impact becomes visible in official production data, the opportunity to respond has already passed. What makes constrained output so powerful as a price driver is its asymmetry. Demand can surge quickly, driven by industrial growth, policy changes, or investor behavior. Supply, however, responds slowly, often over years rather than months. This mismatch creates an environment where even modest increases in demand can trigger disproportionate price reactions. In such conditions, volatility is not a sign of instability. It is a rational response to scarcity. There's also a strategic hook in the way markets process constrained supply. Participants begin to price not just current availability, but future risk. The possibility of shortages, delays, or geopolitical interference becomes embedded in valuations. This forward-looking adjustment can push prices higher well before actual deficits appear. Silver, with its growing industrial relevance and limited production flexibility, fits this pattern precisely. The deeper implication is that constrained mining output transforms silver from a cyclical commodity into a more sensitive economic indicator. Prices no longer simply reflect current consumption, they reflect the market's attempt to ration limited supply across competing uses. When production cannot expand to meet rising needs, price becomes the only balancing mechanism left, and it tends to move faster and further than most expect when that realization takes hold. Periods of macroeconomic instability have always forced markets to confront uncomfortable truths, and the current environment is no exception. Rising sovereign debt, persistent inflation pressures, and repeated interventions in monetary systems are steadily eroding confidence in traditional financial structures. When currencies lose purchasing power and policy responses become increasingly experimental, investors begin to reassess what actually holds value over time. This reassessment is not ideological. It is mathematical. Real assets, by their nature, cannot be expanded at will, and that limitation becomes increasingly attractive when everything else appears endlessly adjustable. Silver occupies a unique position within this shift because it bridges two worlds at once. It functions as a monetary metal with centuries of history, while simultaneously serving as a critical industrial input for the modern economy. In times of stability, this dual role can dilute attention. In times of instability, it concentrates it. Investors seeking protection from currency debasement are drawn to silver's scarcity, while industries dependent on its properties are forced to secure supply regardless of price fluctuations. This convergence creates a powerful demand base that is resilient to changing economic narratives. Inflation, in particular, acts as a catalyst for renewed interest in tangible assets. As input costs rise across the economy, the value of materials embedded in essential goods becomes more visible. Silver is not a passive store of value sitting in vaults. It is actively consumed in technologies that underpin productivity and growth. This means its relevance increases precisely when monetary systems are under strain. The more policymakers struggle to balance growth, debt, and price stability, the more attractive assets tied to physical reality become. Another layer of instability comes from currency competition and geopolitical fragmentation. As trade relationships are redefined and supply chains are reassessed, reliance on universally accepted non-sovereign assets increases. Silver does not depend on the credibility of any single government or central bank. Its value is recognized across borders, cultures, and economic systems. In an environment where trust is unevenly distributed, that universality becomes a strategic advantage. The hook in this macro backdrop is that markets often underestimate how quickly sentiment can shift once confidence begins to crack. Investors do not move all at once. They reposition gradually, reallocating capital toward assets that offer both protection and utility. Silver fits that profile with unusual precision. It offers exposure to industrial growth while simultaneously acting as a hedge against financial excess as instability persists. This combination becomes harder to ignore. What ultimately strengthens the case for real assets is not fear, but alignment. When economic signals, policy risks, and physical scarcity all point in the same direction, capital responds. Silver's growing prominence in this environment reflects a broader realization that value anchored in the real world behaves differently from value sustained by confidence alone. In such moments, markets tend to favor what is finite, functional, and difficult to replace, and that preference can reshape pricing dynamics far more decisively than any single economic indicator.